Okay, good afternoon, everyone, and welcome to, I think this is our fourth masterclass. So welcome from Uganda, from Kenya, Nigeria, Ghana, from across Africa. You're welcome, and thank you for joining us today. So we will start the session quickly, but I'm just going to introduce everyone facilitating the session with me today. So as you know, my name is Ibuko Durinde, and I'm the Entrepreneurship Programs Manager at the Tony Elumelu Foundation. Also joining me is Adora Okoli. Adora is the Entrepreneurship Programs Executive at the Tony Elumelu Foundation. And then we have a guest who is going to facilitate the session today. His name is Segun Malegemi. Is a TF alumni, and he has been supporting us with financial reporting masterclasses since 2018. So, you know, I want everybody to welcome Segun here today. And before I hand over to Segun, I'll just share a few updates based on the email request I've been getting since yesterday. So we basically sent everyone the business plan template. So you don't need to request for access to the document because it's a live document, right? And we can't give everybody access because everybody's going to be updating or editing the same document. So what you need to do is there's an icon on the right side of the document where you can download. So download a copy and save in your folder, on your laptop, on your phone, on your files, on your phone. So you have access to your own documents and you can edit, make changes to the company name or your name, and just, you know, fill in the necessary information you need to. So you don't need to request for access. All you need to do is just download a copy on your laptop or your phone. So I hope that clarifies. And so I don't waste so much of our time, I'm going to hand over to Segun now. But before then, to also apologize that we will not be having Foko and Nadia join us today. They have other pre-scheduled engagements, but we would have a recap masterclass on financial reporting on Friday. And this will just be strictly for our French and Portuguese entrepreneurs who are joining us today in live session. So please, we sincerely apologize for any inconveniences. We would only have this masterclass in English today, but we will definitely have a recap session on Friday. And I trust that everyone will join so that, you know, those that miss out on this particular one can get the desired learning. So thank you, Segun, for joining us, and over to you. Thank you.
All right, thank you. Thank you, Buku. I don't know if you can hear me. Can anybody hear me? So if you can hear me, just say, yes, I can hear you. Can anybody hear me?
Yes, they can. They're sending messages in the comment section. They definitely can hear you.
Okay, fantastic. So I'm seeing the chats, right? And I can see people are saying hello. I mean, it's good to be here. Hello to you too. Also, if you can see my screen, just say, yes, I can see your screen. Just type it very quickly. If you can see my screen, you should be seeing Financial Reporting 101. Just say, yes, I can see your screen. Yes, I can. Oh, beautiful. Matthew, I can see you. Oluchi, I can see you. Okay, fantastic. I'm seeing a lot of yes. All right, it's good to be here. Once again, it's good to have you guys here. So many people. So anytime I have these sessions, I smile too much because I mean, I'm a part of the family. I was on the program in 2018, and since then it's been a journey for me, right? And I can imagine what journey you guys are getting into. Now I'll say this for clarity, right? And this is to make you guys calm down. Yesterday I put it on my handle, and I said I was shocked that people asked a lot of questions in our time, but I found the model so interesting that the model that Tef shared so interesting that I just kept on digging in, and I kept on helping so many friends. And now today is what, 3-4 years, and I have been taking this session year after year. So I'm sitting from a point of view like I'm on your side of the table. I understand your worries, and I'll do my very, very best to make it as enjoyable and as simple for you. If, for instance, if you do not understand anything I'm saying, at the end of the session, there'll be a Q&A time out where you can ask as many questions. I'm happy to go back, right? Because I'm on Zoom and you are on YouTube, I might not be able to pause and, answer those questions real time, but I mean, I'll try as much as possible to come back to your questions. And if proof comes to shove, maybe we'll have a separate session. Okay, so let's just jump right in. Financial reporting, what's it about? Who cares about numbers, right? I've tried to break down the session into 8 major parts, right? I'm going to define the whole financial reporting concept, talk about why we are doing it. I'm now going to expose it to some of the value books. I call them the value books. People use different terms for them. People call them financial reporting books. People call them all sorts of names. I call them the value books, and it didn't come from me. A lot of financial experts call them the value books. Before we now do a deep dive into these value books, I'm going to try and define some of the terminologies that I would be referring to, right? So that you understand as much as possible about the terms you would see when you look at financial reporting and financial reports, right? Then we'll do a deep dive, and I'll give my own layman suggestions on where to start, right? Now, when I was starting this, and this is so that you can all understand what I want to achieve. The overall objectives for me, right, is to ensure that everyone on this call, right, whenever you see a financial report, you are not scared. So I know there are some financial experts on this call, so I'm going to try and, so I might not be as in-depth, but when I'm done, my hope or my agenda is that, my intention is that 80% of you guys or you ladies or entrepreneurs on this call can open any financial reports, look at it without being scared. Because that's the overall objective of this session, right? Okay, let's start. What really is financial reporting, right? Financial reporting really means giving your own stakeholders or any stakeholders an accurate view of the company's financial position using numbers in a predefined structured format. Now, many times when we ask entrepreneurs, guy, how is business now? You go and meet the, I mean, there are a lot of Nigerians on this call, right? When you come and see, go to the capital, guy, how far business, how is things? We always say, we thank God, though, we bless God, though, God has been good, though, business is booming. And you say, business is booming. How come your roof is leaking now? You say, leave down, right? Or you say, boom, business is booming. Like, but you are not expanding. You say, leave down, don't worry, I know what I'm telling you, I know what I'm saying. Or you go and meet someone and say, business is bad. I'm like, business is bad, but see everywhere, AC, you're buying new cars, right? There's a lot of perceptive, there's a lot of sentimental responses to show how a business is or where a business is, right? And it's bad because, it's okay, but it's not the best because people see things different. People interpret things different. Your hello in English could be something else to a Frenchman. It could be something else to the Portuguese woman, right? What financial report does is that using numbers, which is a universal language, they're able to talk about the financial position of any and every company. And the only way it can be universally understood across bodies if it is shared or presented in a predefined structured format. And that's what it's all about, using formats that anybody anywhere can understand. There are 2 major parts of this, right? And I'm going to do a deep dive on those 2, right? There is who needs the financial reports and what really is the structure of this financial report. As we go along, I'm going to talk a bit more on those two things, but just put that out of my mind, put that at the back of your mind. Stakeholders and structured formats. Why do we do it? I have 5 listed, but I have a whole lot more, and I will explain as we go on, right? Number one, the truth about it is that by law, everybody is required to share or give government a report on on your financial status. You might smile and say, maybe it's for companies. You know why you file personal income tax? Because you're actually meant to give government report that I, Mr. Shegun Malegemi, I made $200 billion last year. By law, whether or not it's via a company or the money comes into my pocket directly and no organized and did not pass through any registered company. By law, actually, we are all meant to give accounts or give reports of our financial status to government at the end of every year. But that's by law. So let's leave that. You are required to do that. But let's put that aside. More importantly, right, your financial report actually helps us see the state of your company, right? It shows your accomplishments. It shows your achievements. It shows your performance. It also shows your failures, right? You say, why do I want to know about my failures? Why do I want to know? I'm doing good. Nobody needs to know. As we go along, you see why it's very, very important because, and that's when I start talking about your stakeholders. Thirdly, it helps you in making effective decisions concerning your company's goals. And I'll throw an example, a very, very simple example, right? I am a farmer. I have bananas in my plantation. I have mangoes on my plantation. I do pineapples, right? At the end of the year, I am profitable because people are coming and they are buying. Now, I could just continue planting these 3 different crops or harvesting these 3 different fruits, and I feel I'm good. But just think about it. What if you knew? I mean, okay, I assume that probably you've not done a soil test. The farmers here will know that different soils, right, helps different crops grow differently, which is why in Nigeria, for example, there's a lot of rice plantation in Nasarawa and in the north. We have land in the west, but why don't we plant as much rice as they do in the north? It's because of the weather, the soil, and all that. Okay, let's put that on one side. Now, this farmer that has mangoes, has bananas, and has pineapple, what if he keeps a record that shows that this is what I get from bananas, this is what I get from pineapples, this is what I get from mangoes every year? And he also puts it there that, okay, whenever I do pineapples, this is how much I spend on cultivating pineapples. This is how much I spend in taking care of my mango trees. This is how much I spend on the banana plants, right? If at the end of the year, he sees that the money he puts into growing pineapples, right, is able to get a 200% profit. Meanwhile, the money he puts in taking care of the mango trees, he's just getting a 10% profit. Now, both are profit, right? But if he has numbers, he, as a very sharp person, as a very smart businessman, as a very, very forward-thinking entrepreneur, should automatically know that rather than focusing on mangoes, I need to increase my investments in growing what? Banana. You see, if he didn't have those numbers, he will not be able to think in that way. He will not be able to make those kind of strategic decisions. Financial reports, having those numbers, having those books help you see your business from a bird's eye view, and it helps you, guides you on how to make very, very key decisions concerning growth. For me personally, right, it has helped me remain accountable. And it's funny, right? I think I have been keeping records. I think I was even going to show it, right? I have been keeping personal records since 2018 after the TEF program. Let me just see if I can just find it. I know I brought it up when I was laughing about it, right? I don't know who can see my screen, right? If you can see the Excel sheet I'm showing, you can see 01/02/2018. Starting balance. It was a personal loan, 500,000 naira. This is what I used to start my business in 2018. If you look at it, the cost of my logo, the cost of my trip to Ghana when I needed to go and do some work there. I mean, all this, it helped. I mean, it's just there. I have it from 2018. This was very, very simple. This was very, very crude, right? But it's a financial report, right? It shows me my ins and it shows me my outs. If you look at on the other side, on this, you see where I said I'm spending too much, or it's dangerous for a business to have too much cash. It looks very, very irrelevant. But because I had this back then, it helped me know what I was doing right. It helped me know what I was doing wrong. It helped me be what? Accountable. Very, very important. Very, very, very important. I mean, and I'm hoping that I'm able to get you guys to, or rather some people on this call, to change their perception concerning keeping records. Records doesn't have to be very deep or very, very complicated. Simple ins and outs are very, very important for every business. And it's actually very, very important for your own business. And the last thing I put on, I mean, so I have so many other things, right? For example, right, you can, and I have this note here where I said, during difficult times, the book can help allay fears and focus and help, show the focus of the business. Very, very important. And I have so many, but I'm going to use the next slide to talk about those in a different light. The very last point I have here is, if you consider your stakeholders, right, there are very, very many more reasons why you should keep financial records or have financial reports. Next slide. Who are my stakeholders? I'm going to use this to give you guys another 5 or 6 reasons why you should keep your books. Okay, so we've talked about government, right? We've talked about government, we've talked about tax agencies and why you should keep it. If you're not, I don't know how many of you have actually seen FIRS. FIRS is for the records, for the purpose, for those who are from other countries, it's our Federal Inland Revenue Service. They're the ones who are authorized by the government to go out and find out who's making money and collect money as tax, right? If, for example, these guys come into my office and they see everywhere is looking spark and speak, everything is looking so nice. They see ACs, they see cars, they see everybody smiling, they see laptops. They could come and say, where are your books? And I say, I don't have books. They are authorized by law to come and say, well, based on what we see, you are owing government X amount in tax. If I have my books, I can go and say, well, what you see looks good, but part of it was a loan from a bank, which I used to set up. Part of it were assets that were acquired maybe last year, or the land you are seeing, for those who are into agriculture, we didn't buy it, right? Or it was gifted to us, or we've been here for 5 years. We didn't just acquire it this year. So you cannot tax us unnecessarily. It's very important. For investors, if you have very, very good books, right? You know what it does? It gives your investors a sense of how well your business is performing. For those who are in tech startups, you know how it is, right? People they come and say, what's your traction like? And you're meant to come and say, well, we've been on for 6 months. We've made X amount in sales. If you do not have financial records, right, or reports to show how well your business is doing, you might lose that investor. And especially now where everybody's everybody's looking for money to try and scale up their businesses, it's critical that you do not allow something as simple as this stop you from receiving that investment. For a couple of people here, maybe you're in partnerships and one guy, you have a partnership and one person is responsible for finance, another person is responsible for operations, another person is responsible for investor relations, right? The investor relation guy has to have the figures, right? He has to be able to say, this is what the operations person is doing. This is what our report shows. This is how well the business is. Should we do something different? Should we go and raise funds now, or should we hold on? It could let you guys as partners know if you need to bring in a new partner, if you need to go to a new country. And it's not just partner at the partner level, even at management level, for those who have very structured organizations where there's a CEO, there's a CXO, cadre, and then there are GMs, there are senior managers, there are assistant managers. Each manager's cadre is going to have to say, this is our ins and these are our outs. If you have a pen or a paper somewhere, you can just put that on one side, ins and outs. And I'm going to do a deep dive into that. But yeah, having financial reports helps companies know how they should invest. It should help them know what kind of decisions they should make. I mean, there's this 80-20 rule that most motivational speakers talk about, where they say, and I think a book was written about it, where they say businesses, let's assume everything you do is 100%. Many times, 80% of your efforts bring in 20% of your results. And actually, 20% of your efforts is what is responsible for 80% of your growth or your increase. For those who are in agriculture, for those who are in fashion, you find out that your revenue many times come from just your 80% of your revenue typically will come from maybe 20% of your key customers, right? Being able to see those financial reports, right? Being able to see those numbers on paper, not in your mind, not based on assumption, could help you know who you should improve support to, or how you can increase revenues from those business lines. For staffs, especially now that people are going overseas. In Nigeria, it's called the jackpot syndrome, right? People are traveling. And you know the first people who lose their staffs, those guys or those companies who are in financial troubles. If your staff do not know whether the company is making money or not, they do not know whether their future is guaranteed. They do not know when, if they stay with you, they are able to, there's going to be growth or going to be increase in their financial, in their salaries. If they think that 3 months down the line, the company is going to close down. And really, this is thinking about it. If I feel a company I'm working with, they have only cash for another 3 months. After 3 months, they're probably going to shut down. From this month, I'm not going to waste time. I'm going to dust my CV and start applying for new jobs here and there, right? That information, that financial report that shows that, oh, the company has enough money, or that shows that the company, we're not doing so well, but we have enough money to to support or to pay our staff for another 8-9 months, or we're just okay, but we see that if we improve on this business line, it's going to increase our revenue. Might be the information that staff or that member of your team needs to have to be able to stay and commit their future to the organization. If you look over there, it also said future stars, right? I have been in an interview where, Gen Z is it's not foreign to us, right? It's something that we're all conversant with. I have been in an interview personally where the person I was interviewing asked the question, please, sirs, have you raised funds? Are you able to pay our salaries for another 6 months? It's a very genuine question. It's a very, very honest question, right? If I have a financial report and I just say, hey, look at this. This is our reports. The company is able to take care of your interest. I'll probably be able to recruit the very best staffs. I mean, look at those who, if today Flutterwave, for example, a Paystack says, oh, we're recruiting, we'll probably get 1,000 CVs or 1 million CVs because it's all out there. The results are there. The reports are there. These guys have raised money. They're doing very well financially. If Shegun says, oh, I'm looking for the very best people from Harvard, I might probably not get as many CVs or many applicants for that role, right? Because my reports are not out there. So you see, all these stakeholders actually need to know the status of your business, and they can only know it clearly from your financial reports. I know I've talked about bankers. I mean, that is literally common sense. Bankers, if you want to get a loan nowadays, they want to be able to see that you have a track record of using the funds appropriately. You have a track record, or your business shows that if you put X amount into the business, you're able to get Y amount in revenue, which will pay for the debt and also sustain your business operations. For some customers, for some of us who do a lot of B2B, and B2B means business to business transactions, right? Many a times, your customers will say, submit your company profile, give us your 3-year financial report, show us something, show us that if we give you the responsibility of supplying us diesel for our generating sets, you will not come back next week and say, sorry, sir, I couldn't supply diesel because I do not have enough cash flows, cash money to buy diesel from my own suppliers. I mean, it's just caused a lot of issues with their supply chains, right? So the very top customers or the very best top businesses would always ask you that, oh, please show us your financial reports. Let us know if your business is structured in a way that you can ensure service delivery. Everybody here, for different reasons, needs to see your financial reports. If what I've said now has not convinced you to start to think around it or to take financial reporting serious, I don't know what could, because I mean, look at this whole slide, right? There's so many people who need to see it. And if they're able to see it, there's so many ways it can help you increase your business, help you grow your business, help you, service new customers globally or locally. And really, why lose an opportunity, right? Why lose? Anyway, let's quickly move on. So I mentioned value books, right? There are actually 4 value books when it comes to financial reporting. And I'll start from the one which we all know, right? We all know what is called the balance sheet. Balance sheet basically shows the value of a company. And I'm going to define all this in bits one by one. So just look at it. If you're taking notes, just take notes, right? There are 4 value books. One is the balance sheet. The other one is the income statement, which a couple of you know as the profit and loss, right? The third one is your cash flow statement. And the fourth one, which many of us are not conversant with, is our equity chain document. So I'm just going to pause and ask a question. I don't know whether I should even black my screen. So I am looking at the chat. I'm going to pause on sharing my screen. So please, can anybody on the group, if you heard what I said about the 4 value books, can you show me what the value books are? What are the value books? Just type it in very quickly. There are 4 value books. Can you tell me what the value books are, please? So I'm waiting. So I'm sure that you people are following me. There are 4 value books I mentioned. Can you, just drop it in the chat. What are the 4 value books? So I'm waiting. 4 value books. Please help me. I'm waiting for you guys to tell me, what are the 4 value books? Okay. Interesting. Okay. Thank you very much. Let me resume sharing my slides. 4 value books: the balance sheet, your income statement, your cash flow statement, and then the equity change document. I'm just going to dive right into it quickly and define these 4 value books and define what they do. Again, my intention is that after this class, anybody that sees any reporting, financial reporting statements will be able to look at it and understand you won't be scared to look at it. And when you look at it, you should be able to interpret what it says. Now, before I go into the 4, I'm just going to define some common terminologies that you would see. And these are very, very important, right? They're very, very important for you to know, because you'll probably use them every time you have to look at your financial report, every time you have to create your financial report. And I'm going to start with assets, right? Assets is anything that a company owns. Anything that a company owns, anything that a company acquires is called an asset, right? Liabilities refer to things that you owe. You're owing it, you have a bank loan, you purchase something on credit, you bought something from a customer, anything that you owe to a third person or to a second person or a third party, right? It's called a liability. Revenues is any income. Revenues is also called income, right? So revenue, income is any inflow to you, any monies that come to you from a service offered or from a good sold, is called revenue. Equity, which you would see it's a very common. Equity is any part of your business, right, that is owned by someone. And I'm going to say that again, really, so you can understand the difference between equity and assets. So if, for example, you are about to start a business, right? I'm about to set up a very massive shop, right? I could go out and say, I need investors. I need people who can invest, get into this business with me, right? If we say we're looking for 100 naira and somebody brings in 20 naira, or if we say looking for $1,000 and somebody brings in $100, the person has invested $100 in a $1,000 business. It typically can claim an equity of $100 at $1,000 valued company. That's $100, which is actually about roughly, is exactly actually 10% of the business, is his equity. He can go out and say, I own 10% equity in that particular business. It's anything a stakeholder, a shareholder, or an investor has put into that business and can claim to have rights in the overall stake of the company. Capital is any amount that you raise to invest in the business. Interest is, for example, so people define interest, right, differently. Interest in this scenario is any amount you need to pay in addition to whatever loan that you have collected. Is called an interest. So if you look at this area, right, of my screen, I actually used a CLOGS. CLOGS really, and I said versus total expense. CLOGS is defined as the cost of goods sold, right? For example, if you are in the fashion business, right, and you have to, and a customer comes and says, oh, I need to order a dress from you. Help me make this dress. The cost of goods sold, right? I mean, your revenue is the cost you sell the cloth or the piece to that particular customer, right? The cost of goods sold basically is every expense you had to make to produce that cloth specifically. And I separated it, and that's why I put the versus total expenses. I separated it intentionally because you'd see, I mean, as we start looking at the profit and loss statement, why it's different from your total expense. You see, you went and you bought fabric, you had to enter a bus to go and pick up the fabric, you had to buy needles and threads, or, to make that dress. You had to put fuel. If you don't have power, you have to put fuel in your generator to produce that piece. Every cost associated with making that particular dress is called the cost of goods sold. Now, it's different from the total expenses because in your total expenses, there are other things that you've spent that were not actually part of the cost of making that particular dress. For example, the shop you have, if you have a massive shop in Lagos Island or somewhere in Abuja, is not that expense that you had to make to acquire the shop is not actually directly or is not directly connected to the cost of making that particular dress. For example, you have a company car which you use to go to customer places, and you have to pay for that car. You have to buy the car, right? It's not part of your cost of goods sold. It's an expense yet, but it wasn't made for the purpose of servicing that particular customer. That's where the difference is. So cost of goods sold, and I need you to take note of it, especially those of you who like to play with numbers and might be interested in actually creating your own financial models, right? Cost of goods sold is any expenses that you had to make in order to fulfill a customer request. The total expense, it requires, of course, obviously, as self-explanatory as it is, means every expense you've had to make in the course of your business, right? Next term I would like to define before we move to the next slide is your net profits and your gross profits, and then your net loss and your gross loss. Let me first start with defining what your profit is. Your profit is any amount above the cost of goods sold that the company has made from offering a service or selling a product. Typically, so your sales amount minus your cost of goods sold, or is a profit, but it's actually, it's a profit. Okay, let me not jump the gun, right? Because I see them. Now, if your sales amount minus your cost of goods sold is positive, it's a profit because you made more money than you spent, right? If you made less money than you sold, obviously the number is a negative. It's called a loss. So loss, profit, and I'll take it one more time. Profit is any amount you made above the cost of the goods that was sold. If it is positive, it's called a profit. If it is negative, it's called a loss. So if the cost of producing the goods was more expensive than the cost at which you sold that, than the price at which you sold that goods, it's called a loss. Now, net profit and net and gross is a term used when you are trying to look at your overall cost of running the business. And I'll explain it as we go along in the slides. I hope you are following me. If you have any questions, again, just hold them, and I'm very, very happy to answer them after the presentation. Okay, now it's getting hotter in here because we're now going into the crux of the matter, right? Now, remember, there are 4 value books. The very first one is called the balance sheet. The balance sheet is a report, and this is the definition. The balance sheet is very, very simply defined as a report that shows what a company owns versus what it owes. What a company owns, which, if you recall, I said is our assets. And it also shows what the company owes. And I remember taking time to define liability and equity, right? Equity is what is owned by the investors in the business, their stake in the business. Yourself, if you are the founder of your own company, and I need to be very, very clear, people tend to, I know it's very confusing, so I try and break it down as simply as possible. Now, when you set up a company, the company, especially if it's registered, right? I don't know all the rules in different countries, but in Nigeria, if you set up a limited liability, that limited liability company is considered an entity by itself. So Segun, the investor, is different from Segun, the business owner. The company, Segun, the company, actually owes me, Segun, the investor, based on my equity, right? Also, Segun, the investor, right, owns equity in Segun, the company's business. We're 2 separate entities, even though I might be playing the same roles. So when I drop, or when you create a balance sheet, the balance sheet shows a report. It's a report that shows everything Segun, the company, owns, right, on one hand, and everything Segun, the company, owes, to both in terms of to my suppliers and to my investors, one of which is Segun, the person. Again, why is it very important, right? This document actually, and I'm going to read directly what I wrote there because it's self-explanatory. This document conducts a financial health assessment of the company and helps measure the reduction in the value of these assets over time. One thing I need to state is called the balance sheet because at every time, what the company owns must equal what the company owes. I'm just going to go straight to the next slide that shows like a typical balance sheet document, right? This is very typical. This is what you see. What I have here is, and I'm going to state it, it's the TET format for preparing financial reports, especially as it relates to this program, right? You're allowed to, so basically, most balance sheets look like this. What differs is the number of items, right, that are in there. Some companies actually break down assets into bits and pieces, and they break down, and they're very detailed when they're talking about their liabilities or their equity. In this case, it is summarized, it is made because, again, this document is for SMEs, right? But this is typically how every balance sheet looks. If you notice on the top side of this document, we have the assets on top. And that's how all balance sheets look like, right? All balance sheets, all assets are placed on the top. And then once you finish listing all the assets, right, then you start listing your liabilities. Now, in the way it's arranged is also, remember we talked about when I defined financial report, it was about having, representing the documents with representing the company using figures in a pre-agreed structure or in a structured format that is known by many people, right? This is how balance sheets, I mean, this is the national standard, the global standard for creating balance sheets. Assets are on top, liabilities are below. Assets are also arranged in a certain format where your most liquid assets are on top. Then it comes down to your least liquid assets, and those are called fixed assets. In this case, for this format, it is listed as your non-current assets, and this could include properties. If you bought equipment, if you bought laptops, if you have a farmland, the cost of the farmland. Of course, the farmland is not free; it has a value. All that is captured in your balance sheet because it shows the value of a company at every point in time, right? It's meant to show everything a company owns. It's meant to show everything a company owes. Again, I'll say it, the way it is arranged in your asset, it starts from the most liquid at the very top all the way to your least liquid. Again, if I was to break this down, and this is very important, right? So that you're not scared. You could, if you see a company and you look at their statements and it looks broken down much more than this, just try and look through it. If I was to create my own balance sheet right now with my own experience, I'll probably start with the cash I have in my wallet, which is cash in hand. I'll probably list the cash that is with my CFO or with the finance guys, which is just in their decks in the safe there. Then I'll go and I'll probably talk about the cash in the banks. Next is, okay, after I've listed the cash in the banks, I'll probably list the cash that for goods that have been sold, but they've not paid me. Again, that is the account receivable. For those, and I'm going to use this point to define that accounts receivable. And it's typical with some of us doing business. Many times when we sell our goods, we're not paid immediately, right? For those of us who do a lot of B2B business, they'll tell you, oh, we'll pay you after 15 days. Or they come and they'll tell you, oh, we'll pay you after 30 days, right? We'll pay you after 30 days. Even though I have sold it, right? And it's no more in the physical form. The company is owing me, he hasn't paid me. I am not as liquid. If I'm going to take note of that amount in my balance sheet, I would add other amount and it to be under my accounts receivable. The next thing, after talking about accounts receivable, is probably now start talking about things like your inventory. How much do you have in stock? Some people would say inventory that has been processed. They will now separate it from inventory that is in its raw format. You know, for those of us who are in production, for those of you who are in fashion, you probably say, and you start with current assets. You talk about cash in your accounts, cash in hand, cash in bank. I have delivered Lagbaja's dress to the person. The person hasn't paid me, but that's almost cash. It means that I can very quickly go and collect my money from that person if I need it, right? The next is I'll talk about my inventory. I have made 20 other dresses and they're just in the store. I know that, okay, I can also take and go, once I sell it, I'll probably get money from there, right? And then the next thing on our list is the clothes that I have not even sewn at all. They are inventories, but again, it's difficult to convert to cash, right? But it's part of the inventory. All this is listed on the asset column of your balance sheet. Then you now go on to liabilities. Liabilities is everything you own. again, almost like the way we did, the way we had the current asset, right, at the very top, and then the least current asset at the bottom. In the same way you list your most what's the word? The same way you also structure their liabilities, right? And you start with the part that is for services that you received that you've not paid for. Then you now start talking about tax. Okay, the government. So any day, the most important expense to me, most important liability to me as a business is for services that have been done to me, but I'm yet to pay for. Okay, so the person delivers diesel to me. I have to pay for that. That is more important. That is my most urgent expenses. Next, probably it would be tax, right? Again, for most countries and Nigeria, you don't have to pay your tax to the end of the month. Some countries, you pay at the end of every quarter. Some countries, you pay at the end of every year, right? I also have to add that as part of my liabilities, right? Because it's money I owe. Then you now go to your non-current liabilities, which could be long-term loans. For example, you take a loan to buy a farmland, you take a loan to buy a building, you take a loan to buy a car. They are non-current, right? They are long-term liabilities which you pay over time, right? All that is your liabilities. Again, at the bottom, again, remember, you have the assets at the top, then you have the liabilities and equity at the bottom. On the asset part, you start with your most liquid asset and you go to your least liquid asset. In liabilities, you start with your most current asset, which is the one you actually have to pay for first or most urgently, and go to your least liquid, least current liabilities, which is your long-term liabilities. And after you finish your liabilities, you now start talking about equity, which are your stakeholders' equity, which could be maybe people invested in your company, or the company, again, invested in company. Maybe you made profits and the money is reinvested into the company. All that is listed in your balance sheet. Three things I would say before I finish with your balance sheet is, balance sheet shows the state of a business. If you forget anything I've said, remember this: balance sheet shows the status of the company. It lists all a company owns and all it owes, right? It's in the structure of a balance sheet. You have your assets on the top, and then at the bottom, you have your liabilities and your equity. And then finally, one thing you should note is this: in a balance sheet, the total sum of your assets is usually expected to be the total sum of your liabilities and equity. I know it's, if I could talk about it for an hour to explain why it is done like that and how to ensure you meet it. But I mean, because of time, I'm just going to state that, take note of that, because it might be important whenever you look at any balance sheet and you see that the cost of your assets is not the cost of liability and equity. That document was not properly done. Okay, I'm going to move to the next. Income statement. Some of you know this as your profit and loss statement. It actually shows, if I was to define if income statement, I would say income statement is a financial report document that shows the performance of the business. It lists my sales and it lists my expenditure. Of course, like I say, it's also known as the profit and loss account. It basically shows how profitable a company is, right? This is very important, right? This particular document is very, very important because it's for anybody that looks at your business. This is document they actually first go to because they want to know, does your business make sense? Does it make sense to do this? Is it profitable? If there's any document that they go for or they look for first, it is your profit and loss statement. It is your income statement, because it actually, in summary, shows how profitable a business is. I'll go to the next slide and I'll show you how it is presented. And from this, you would know why I believe it's very important and how you can at a glance understand this. Most people, when they go and they see anybody's income statement, the first thing they go to is the bottom of the P&L document, where it shows either your profits after income. So remember at the onset, I said there is profit, right? I defined profit to most of you on this call. And then I now said there is gross profit and there is net profit. Now, if you remember what I did also, I now took time to define one other terminology where I said the cost of goods sold, right? Now, all these terminologies come to bear in this particular document. I'm going to explain the structure, right? And I'm going to explain how you can quickly build your own income statement. Now, the first thing in your income statement at the very top is your revenue. So you list out all your sales. So you sold to customer A, you sold to customer B. If you are selling different products, okay, you sell mangoes, you sell pineapple, you sell banana. You probably say revenue from mangoes, revenue from banana, revenue from pineapples. All that revenue usually comes at the topmost part of your P&L document or your income statement, right? All that put together becomes your total revenue. It means, and this is where many people get it, they'll say, oh, I sold mangoes, I sold bananas, I sold pineapples, and I have a revenue of 45 million, right? I am a very, very rich person. As an investor or as a partner or as a business manager, I would say, oh, fantastic, revenue is good, right? How much did I spend to make this revenue? And that becomes your cost of goods sold. Remember how I defined your cost of goods sold? Cost of goods sold is also, in this particular scenario, defined as your direct cost. It's the total money spent in order to service an order. So you, for example, again, the fashion person, I sell 20 dresses, or I sell 20 shirts, or I sell 20 t-shirts. What is the cost of buying the fabric? What is the cost of transporting it to the store? What's the cost of producing this? If, for example, in this case, the cost is 8,000. Now, your total revenue minus your direct cost, which is 8 million in this case, sorry, not 8,000, it's 8 million, right? Now, for the records, and I'm going to point out this, now, anytime you see in an income statement or in any financial document at the very top, you see a 000, it means that all the figures that are listed there are in thousands. So this is mathematically 8,520,000. If I was correct, that is basically really 8 million, yeah? I'm saying that for those of you who are not comfortable with or conversant with some of these numbers. So this, although it is 8,000 here, because there is 000 at the top, signifying 1,000, it's actually this multiplied by this, and so it's actually 8 million, right? So, okay, so let me not confuse you more. Let's just go straight to what I was explaining, right? So you have the total revenue. The total revenue shows how much comes into the business from direct sales, right? After that, you have to ask yourself, how much did it cost me to produce whatever I sold? The total revenue minus your direct cost is what we all classify as profit. But in this case, it's your direct profit, right? Also known as your gross profit. So gross profit is basically your total revenue from sales minus the cost of goods sold, or minus your direct cost in this case, right? After that, on your income statement, you now have to list all your indirect expenses. Indirect expenses would probably now, or rather includes maybe your salaries, your rent, cost of marketing, cost of administration, cost of maintenance, every other expenses that you had to make within that period in question are expenses, but they might not be part of your direct expenses, but they're still part of your expenses. And in your financial reports, you actually have to account for them. All that is accounted for in your income statement. Now, after you calculate all that, you add all your direct expenses, you add all your indirect expenses. If you make profit, all that is listed as your operating profit. Now, even after your operating profits, or in some cases, and I'll say this, in some cases, you might not be having a profit. It doesn't matter. In some cases, it doesn't matter. And this is a quick advice. Never try to manipulate your financial reports. I think it's a dangerous thing. And it's a mistake many people make, right? Financial reports are meant to be honest and transparent, right? They are not meant to necessarily criticize you. Rather, they are meant for you to be able to look at it and analyze how well your business is doing and be able to make serious decisions that will help you move towards profitability. Now, if your numbers, because you don't like what you saw, you now start playing with your numbers. If your numbers are wrong, you probably make wrong decisions and it will come back to bite you, right? Just take note of that. And that's an advice on one side. On the other side, and let's just go back to the income statement. Now, if after making an operating profit of say 20 million, that is not yet your net profit because, for example, you still have to pay tax. Now, operating profit less your tax obligations, right, is what we all now know as your net income. And this is where we all try to get to. This is the summary of any profit and loss or any income statement is your net profit. Your net profit is basically defined as the amount a company gets to keep for itself after transacting business over a period of time. So if after 6 months, right, I have sold 1 million naira worth of goods, I have deducted 50,000 because that was the direct cost of producing it. I have deducted another 100,000, which is the cost of maintaining my offices, paying salaries, advertisement, marketing, transport, and then I now deduct another maybe 50,000 for tax payment to the government. Any money I have after that period is what we now refer to as your net income. Yeah, I see a lot, guys. I see a lot of French, a lot of people, my Francophone brothers who are dropping messages. We'll probably have a session with you. And I was meant to say that at the beginning of the session, actually. We're going to have a separate session with you and for you where we would go through everything I'm saying now. So do not be worried. Just try and follow as much as you can. But yes, we're going to have a session with you to take you through some of the things I'm sharing here. So let me move forward. This basically is what the profit and loss document. For the records, as a summary, let me say this again. The profit and loss statement, which is your P&L or your income statement, is a financial document which helps to show the profitability of any company. It lists your revenue from sales. It could be direct sales, it could be indirect sales, it could be from consulting, it could be from other services that the company gets into. And then it also lists your expenditures. And then the net of it, which is your sales minus your expenditures, is really the goal of a financial income, is really the goal of the income statement, which is to find out if the business is profitable or was profitable within a particular period or can be profitable based on its activity. It's a very, very important book. And it's one of the major value books when it comes to financial reporting. The next is your cash flow statement. Now, this is actually the simplest book to create or the simplest book to prepare, but it is actually one of the most important books, value books. It's simply critical. I tell every entrepreneur, if you don't do anything, keep your cash flow statement. Your cash flow statement really shows the liquidity of a company. A cash flow statement can be defined as that document, that financial record that shows how much liquid cash the company has. It does this by showing how much money comes in and how much money goes out of the company. I can't emphasize how important this book is, right? Because especially in Africa, right, it's difficult to get loans. It's difficult to get alternate source of capital, right? If you do not have your cash flow statement that shows how much leg room you have to run your business, you might end up making very, very bad decisions that will put you into trouble. If you do not keep any book by yourself, if you do not monitor any book, any of the financial records book, if you do not know how to prepare anyone, I advise strongly that you know how to prepare your cash flow statements, because it could make or mere the decisions it could make or mere things for you based on the decisions you make have with information at your disposal. How is it? Again, the cash flow statement is it also has a structure, right? It's really the simplest, right? This for me is, for some of you might even be too complicated, right? It might be too complicated, but this is the structure of a cash flow statement. At the very top are your operating activities, right? It shows all your earnings. For example, earnings from, and there are three major sources of earnings for most companies. They are the operating earnings, operating inflows, there's the investing inflows, and then there's the financial inflows. With the way this was created, right, it's easy to group them in, it's easy to group your expenses. Operating inflows or operating cash flows could be, it's any expenses that have to do with the operational requirements of the business, right? For example, a customer paid for the clothes I made. It's an inflow. It's coming into the business, right? I had to pay for salaries. It becomes an outflow. You record it there, right? A customer, I invested in one company and then they get declared profits. It's an inflow. I had to pay out for, I had to pay for diesel. It's an operational activity, but it's an outflow, right? Cash flow statement just shows, and I'm going to define it over and over and over again so you get it, and it's simple and it's easy for you to understand how to create this yourself. Cash flow statement is any document that shows how much comes into your business and shows how much leaves your business over a period. Again, they're divided into three. Operating activities, which show basically all the inflows and outflows based on the activities of your company. We also have the investing activities, which shows how the company invests in capital acquisitions. For example, you bought a new property somewhere, the company acquires a new office. It's not an operational, right? It's not a day-to-day expense. It's something you just make once, right? So it's called an investing activity of the company. Or, for example, and so it's an outflow, right? In this case, purchase, and this is clearly described here, purchase of CapEx, 2,750,000. It's an expense. It's negative. Anywhere you see a bracket covering some figures, you know it's a negative figure. It's an outflow. If by adventure this particular business sells its property, it's not a daily sales, unless, for example, unless maybe you are into real estate, right? At that point, these properties become, these are expenses operating ins and out, right? But if you're not a real estate company, all that sale of a property or purchase of a property is listed as your investing activity. The third part of your cash flow statement is called the financing activities, which really basically has to do with inflows and outflows from investors or financial partners. For example, you take a loan, it's an inflow, right? But it's listed under financial activities. If it's a positive because it's a cash, the money from that loan comes into the business. When you are paying the loan, it's a financing activity, but it's an outflow. If, for example, somebody invests in your business, there's an inflow, right? It is paid into the business. In your cash flow statement, it is an inflow. If, for example, you buy off the company buys off an investor, there's a outflow. It's negative, but it's listed as part of your financing activities in your cash flow statement. Again, the cash flow statement shows your ins and your outs, and they are categorized into three: operating activities, which has to do with cash flows from daily operating activities, your day-to-day activities of the company, your investing activities, which has to do with majorly how you invest your funds, especially when it comes to acquiring assets or disposing of assets, and then your financing activities, which has to do with investors, your relationship with investors and financial partners, right? At the end of the day, when you do your additions and do your subtractions, you are able to know how much cash you have at the end of that period. In the case of this sample document I have here, it is calculated year by year. Some people do daily cash flow statements. Some people do weekly cash flow statements. Some people do monthly cash flow statements. All I can say is that it's important at every point in time to know how much is coming in and how much is going out per time, so that you don't get yourself into trouble as a business. So I've listed 3 financial statements or financial reporting documents, right? I listed the balance sheet. I now talked about the income statement, and then I mentioned the cash flow statement. I'm going to quote something that somebody said, Alan Mitz, and he said, revenue is vanity, profit is sanity, but cash is king. Your balance sheet is vanity because it shows how much a company owns. If you look at the balance sheet, some company, you'll see, oh, we acquired 20 properties. We've done this. We are big. Our balance sheet consists of everything a company can claim to own. But really, as far as a business person is concerned, that really is your ego. It just shows, well, you have this asset, it's fine, right? But more importantly than having this asset and going to business, you have to ask yourself, are you even profitable? And that's where your income statement is sanity. Income statement explains the reason why you're in business, right? But yeah, you might be business, you might be profitable, but some customers are not paying you, right? They are paying you 30 days after, 40 days after, right? It's sanity. Income, profit and loss, income statement is sanity. It's a fantastic book to have. But you see, your cash flow statement, and I'm using it to expatiate the importance of the cash flow statement. Cash flow statement is king because it is what tells you for how long more you can keep those doors open. It tells you again for how much more you can keep those doors open. I'm going to read the last thing I wrote on this slide, which is the cash flow statement is the most grounded in reality, because in business, how much you keep and how much money is in the bank after covering your expenses is what really matters the most. Because, for example, if I have 20 properties or 20 acres of land, I'm farming rice, and then one day I realized that I did not have cash in the bank to pay my laborers. I realized I did not have cash in the bank to buy diesel in the tractors. I realized I did not have cash in the bank to buy fertilizer. You know what will happen? My workers would leave because I will not be able to pay them. My tractors will be packed in the field because I don't have diesel to power them up, right? And my plants would die because I cannot afford fertilizers. I know what's going to happen to that field or to the farmlands. All I'm going to get is reduced yield and a farmland full of weeds. And if that is the case, I don't have a business. If that is the case, there's no point of me doing business, because I'll probably have shut my door down by that time. So what am I trying to say? All these documents are very important. All these documents together help me see the state of a business. I can know the state of my business. I can know, I can have a bird's eye view of what I'm doing, but together by themselves, one by one, it might not show me, they might not give me the full picture, but if I'm able to keep these different books, together, they can tell me the state of the business, and help me with I'll help not just myself, but help all my stakeholders make the right decisions for the business. So those are the three most important books. There's a fourth one, which I mentioned, which is the equity change document. This equity change document, also called the cap table document, it just helps us know, who has what in the company, how many percent of the company is owned by Mr. A, how many percent of the company is owned by Mr. B. Most times this doesn't change. People only prepare this document and share it whenever a new investor comes into the company or an old investor exits from the company. It's required by law. And yeah, it's important for you to always have it, especially if you're going to be talking to new investors. I think this is one of those documents that for those who go about raising funds is required by most of your investment partners. They like to know who has what in the business. So it's also an important part of the documentation. Yes. So I know a lot of you have questions, right? And I'm going to answer that very soon. But in rounding up, I would like to, I always share, tell people this, right? Financial reporting is important. It's important to you as a person. It's important to your stakeholders, both your internal stakeholders and external stakeholders. Internal stakeholders meaning your partners, the management team, your staffs. External stakeholders meaning maybe your investment partners, the banks who want to give you loan, governments who wants to know how much they should tax you, right? And without a doubt, it's best you keep it without being forced. Without a doubt, it's important for you to just have them for yourself. It's important for you to start keeping these books, without being pushed, And so I tell people, start small, start already. If you do not have books, start keeping. And it doesn't have to be all these value books in the format I raised. These are complicated books that take time to develop. It takes a lot of understanding. What do I tell people? Start the way I started. Start small. Cash flow statement, lists, just create a ledger. Show how much comes into the business. Show how much leaves the business every single time, right? Just start the documentation process. For some of you who say, "Oh, I want to take it a step further. I want to do it myself." There are so many accounting tools available. There's QuickBooks, there's Sage, there's FreshBooks, there's Zoho. There are some that are free. There are some that are paid for. There are some that are free, but at a certain point in time, you have to pay for it. Go online, use these books, try and take note of all you do with funds in your company. Some of them have user guides that help you break down your expenses. If you look at the format, the sample document I shared, there are different types of expenses, right? Your assets, you could have capital expenses, you could have operating expenses. These books online help you categorize them so that by the time you are done, without even getting an expert, they can automatically help you calculate or prepare your balance sheet. They could help you prepare your income statement so you can know whether your business is profitable or not. They could help you, prepare your cash flow statement so that you can very easily see how much you spend every period in time, every month, every week, every year. And you can actually say, oh, I have 6 months of running bandwidth if I don't have any inflow. You basically know how much cash you have in your business and how long it will last you. Now, for some of you who say, oh, I cannot prepare these books myself and I really want to start, I cannot afford an accountant. I tell you, there's so many accounting consultants out there. Try and get somebody that can help you prepare your books because, it will just save you a lot of headache in the future. Right now, as I speak to you, I use an accounting consultant. because I mean, all I have to do is just send the statement, my bank account statement at the end of the month, and he prepares all these documents. It makes it easy for me because then I can almost automatically say, no, the state of my business part-time. And if you have a larger organization, if your startup or your business or your SME, your business is big enough to employ an accountant, please get an accountant. I mean, it would definitely save you a lot of headache in the future. Most times, if you have an in-house accountant, he tends to go beyond just preparing your books. He tends to be able to advise you or support you in management strategy meetings. He's able to show you how well the business is doing, where to focus on based on his analysis of the bank statements or of the books. That's one of the bigger benefits of having an in-house accountant. You know, they're able to help you with strategic decision making. Lastly, I say, be the habit of paying your tax. I mean, you don't know when your business, I mean, you might think small, you might think, oh, my business is a one-man business, but you might be selling pure water or selling bottled water. And then one day one company says, oh, sell 2 trailer loads of bottled water. I say, oh, this is fantastic. This is a fantastic opportunity. And they say, and most times in such companies, they'll ask you, please give me your 3 years audited financial reports. That's where many people go and start saying, oh, let me go and pay my tax. Let me go to tax authority. Let me go and get my tax clearance certificate. And it's really the worst time to go and do all that. But however, if you had already had a habit of paying your tax month on month or quarter on quarter, on year, it would have saved you a lot of headache. It would have saved you a whole lot of headache. And I mean, that business thing might be the breakthrough you've been praying for. So really start now. Do not wait till you're at that point in time before you start running helter-skelter. Pay your tax and you know, for anything, it's really not your money. Most of the time, the tax required by government is the VAT, which is added on your invoice, right? VAT is the money added on your business, on your invoice, which is meant to be paid to government. And then withholding tax. In Africa, I think we pay the lowest company income tax, right? But if you do not pay it now, you will probably not be able to apply for a tax clearance certificate, and you're probably able to lock those business deals with large customers because they're going to ask for it. Yeah. Advice: start now, start small, start anyhow. Use an advice if you can, if you feel you understand these principles enough, use online accounting tools. If you can't, get an accountant. If you're saying, okay, I'm not at a stage where I should get an accountant, get a consultant, an external consultant who helps you prepare your document, but just start. Summary: 4 value books. The top 3 include your balance statement, your income statement, and the cash flow statement. The purpose of financial reporting is to use numbers to report the activities of a company. Each book provides a different view of the company's financial situation with its unique benefits and limitations. You know, individually, you might not get the picture you want, but put together, if every single one of them is put together and you can understand what they mean, it will give you a good view of the company's financial position. And then many times, I just added this, every single transaction or business event might be reflected in more than one document, or maybe in all. That's the way it is. But in the end, it's for a purpose, right? The purpose is to understand how well the business is performing. Reminder: financial reporting helps you as a business, you know, to communicate your past successes, and it focuses your future potentials as a business. I hope I have been able to convince you on how important this is. I hope anytime, based on what I've shared today, anytime you see a financial report, you'll not be scared to pick it up. I hope I've been able to encourage you to just even start preparing yours. And I want to say thank you for joining me today. If you have any other questions, I would love if maybe Adara, you could help me with the questions. I know there are so many questions people might have to ask. I'll be very, very happy to take them and answer them within this session. Over to you. Ibukun, Adara. Okay, so while I'm waiting for them, I'm looking at the chats. If you have any questions, you can just drop your questions in the chat room, and I would be happy to answer them. Okay, so many. Thank you. Yeah. I mean, I'll be happy to hear the question. What's the difference between? Okay, so I can see. Lauya asked a question. What's the difference between interest and profits? Okay, good question. So profits is usually what a company makes, right? Interest is what a company has to pay out most times. So for example, people use interest when they're talking about, oh, the company borrowed money, they now have to return the money. How much more did they agree to pay with the capital they borrowed? Is usually how we look at interest. On the other hand, profit is saying, oh, the company did a financial transaction, they sold X amount of goods. How much did they make after deducting the cost of goods sold is what is referred to as profit. I hope that answers your question, Lauya. Someone asked that, what if land is not a rented one? And I'm sure this is Adebanjo Ibrahim. I'm sure you're asking that question in light of looking at what is capital expenditure and what is recurrent expenditure. Now, if you buy a property, if you are in a property and is rented, any expenses you make is not considered. So that property is not considered a capital expense. It's considered a recurrent expense, meaning that it's something you pay over and over and over again. It is not listed as part of your assets. No, it is listed as one of your liabilities, because again, you're obliged to pay your landlord consistently for that service. I hope that answered your question. Sorry, there's this chat room. These chats are coming in, so I'm having to look at it. So I mean, okay, I've answered this question. Adara, can you help me with particular questions? I mean, I'm reading through, but I mean, if anybody has questions.
Okay, Shegun. So I have a couple of questions. I'll just read out the question shortly. If you just give me a minute. Okay. So who writes when my balance sheet is negative, what can I do? Your advice, please, sir.
Okay, so your balance sheet should never be negative. I wish I could write on my screen. The balance sheet, usually, your assets must always be equal to your liabilities plus equity. Let's see if I can go back. So your balance sheet should never be positive, which would technically imply that your assets are more than your liabilities and your equity. Neither should it be negative, meaning that your liability and your equity is more than your assets. It should actually balance. So if it doesn't balance, if it's either positive or negative, it means that in calculating, you have missed out one or two things. And it's always best to go through it or get a financial expert to come and look at it for you. Now, that's on one side. Now, I'm also assuming that, now, let me give a different scenario, and I'm trying to avoid confusion, right? And I might probably rephrase what I think could also be the possible question, which is, if my profit and loss is negative, what do I do about it? If your profit and loss is negative, it means that the business is spending more than it is making, right? It means your expenses are more than your revenue. I'll ask you a question. What I typically tell people is, don't try and force to be positive. Ask yourself, what is happening? It might be that you're making, again, in the first month of opening a business, you're probably acquiring properties, you're buying cars, you're setting up offices, you're employing staffs, and there might be sign-up bonus. Typically, your expenses will be more than your income in the early stages of the business. Does it now mean that you shut down your business? No. What it means that, well, I mean, as a business owner, you need that maturity and understanding to say, these are expenses that I have to make upfront. And so it is fine. What you ask yourself is this: what having financial records will do is that it makes you sit back and say, okay, if this is my initial expense, how long do I have to run my business before I make enough money to cover these initial expenses that I've made? Which is very important for you to know, really. On the flip side, you ask yourself, what expenses can I cut so that I do not go bankrupt? So for example, if you are running diesel and you are running 24/7, you have to ask yourself, okay, do I shut down the diesel generator at 5 p.m. and put it on at 8 p.m. when it is needed, so I can reduce my expenses? So yes, basically, if your expenses are more than your revenues, it's important for you to know how to cut costs or how to increase sales. Or you ask yourself if the business is worth it at all. I tell people, do not be in a rush to close down any business because you don't think it's initially profitable. Try and understand why and take decisions that would move you from being net negative to become net positive. So I answered 2 questions, but I mean, I hope it was useful. Adera,
yes, you have, Shegun. Thank you so much for that question. So we'll just take the last question and we'll round up, right? So the last question is, should financial reports of a company be made public, or is it a confidential document?
Okay, good question. So by law, the financial report of any company, the only people who are obligated by law to make their report public are publicly listed companies, which are majorly those who are on, in the case of Nigeria, the Nigerian Stock Exchange, right? They're expected to, by law, they're expected to announce and publish their reports. Now, if your business is not a publicly listed company, if it's a private company, you are not expected by law to make it public. The only people you should report to at the end of every year or at the end of every month, depending on the regulations in your country, are the government's tax services. So in our case, it is the FIRS. You're expected to make it public. Nigerians on this call, you are not even expected to make your financial reports known to the state government. As of today, what you're expected to tell them is how much you pay. So at the state level, you pay the income tax or you pay the staff taxes to the state governments. All you're expected to show them is, this is how much staff A, B, and C were paid this month. And so this is their tax deductions. And then here is the money, here is their personal tax. But you're not expected to even show the entire company books to them. By law, you're expected to send it to the Federal Income Revenue Service at the end of every year, right? The only other persons you can decide to share these documents with maybe you're trying to apply for a loan and the bank says, okay, we need to be sure that your business is profitable or is sustainable, or to see how your books look. I mean, you obviously should share it, send it to them. Or maybe you're about to get an investor and he wants to see if you are adhering to strict governance policy and good governance practices in the company. Then you share it to them. But by law, if you're not a publicly listed company, you do not need to share it to the public. I hope I've answered that particular question. Adora, I hope I've answered that question.
Yes. Thank you so much, Shegun. Thank you for this impactful and insightful session. I think we'll close the session for now for Shegun. So just a few updates to the entrepreneurs. Thank you so much, Shegun, once again. So just a few updates to the entrepreneurs. So we've been receiving some emails as regards not being able to log into TF Connect, right? So we ask that you check that you're using the right email to log in. Check that you're using the right email to log in. And if you're getting a prompt invalid email, try to do a reset password, right? And from there, if the issue is not resolved, you can send an email to inquiries@tonyelumelu-foundation.org. Also make sure to fill in the attendance. Also make sure to fill in the attendance link. The attendance link that is just in the description, the Tony Elumelu Foundation YouTube channel description. So click the attendance link as it will be closed in a very short minute, sorry, in few minutes from now. So make sure to do that. Okay, so we'll give you till 6 p.m. to fill in the attendance, to fill in your attendance, 6 p.m. Nigerian time, thank you. 6 p.m. Nigerian time. Then, thirdly, please make sure to join in the session on Thursday. We're having another session, the TOUA Masterclass Series 3 on Thursday, so try to join in. So I think that will be all for now. Thank you so much for joining this session. Thank you so much, Shegun, again. And our translators, the French and the Portuguese translators will be available for a recap session on Friday. We urge the French and Portuguese entrepreneurs. We're so sorry for today's session as they were not available, but we urge you guys to attend the session on Friday. Thank you so much. We hope to see you on Friday and Thursday as well for the TOUA Masterclass Series. Thank you, Shegun. Thank you, Ibuku.
Thank you,
Bye.
Ibuku.